Welcome to the 3Edge Week in Review for the week of October 25th. I'm Fritz Folts, a Chief Investment Strategist, and with me here today, once again, is Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. Today, along with a brief update of the global capital markets, Steve and I will be discussing market bubbles and are we in fact living in one right now? And importantly, if we are, what can investors do about it? Before we get to that, take a quick look at the recent market activity for the past week. So since we are fast approaching Halloween here in the US, it may be a good analogy to describe some of the fear creeping into the capital markets as we head into the final 2 months of 2021. And even though the S&P has advanced impressively thus far this year, many investors see plenty of potential dangers ahead for the markets, including extraordinary amount of corporate debt that has been issued, extremely stretched equity market valuations, including an S&P 500 index at its highest price to sales level ever. And that's something that we actually discussed in our latest quarterly webinar. And of course, the ongoing persistence of inflationary pressure. Markets also struggled this week as investors focused on a slew of corporate earnings reports for the third quarter, which included disappointing earnings from both Apple and Amazon. Meanwhile, the debate continues over just how transitory inflationary pressure may turn out to be. In Europe, for example, prices rose 4% in October from a year earlier. Their core inflation hit 2.1, and that was a level that they haven't seen in 2 decades. Meanwhile, the price of oil is on track for a 10% price increase in October as consumption continues to outpace supply, thereby draining existing stockpiles. So now let's get to today's topic. And Steve and I, as I said, are going to be discussing asset market bubbles. And it does seem as though every week we're reading about stock market making new highs, while the price to sales ratio of the S&P, as I mentioned earlier, is hovering around its highest reading ever. And interestingly, at the same time, stock market volatility, as measured by the VIX Volatility Index, has now reached an 18-month low. And as we know, it's not only equities that have been making new highs in 2021. A recent report on residential real estate shows that home prices in the US increased by 20% over the past 12 months, which is a record. Bitcoin recently reached a record high price of approximately $67,000. And another interesting piece of the market, which we'll look at in this slide here, it was also recently reported that the value of venture capital-backed startup companies that have gone public thus far in 2021 recently exceeded $500 billion mark for the first time ever in a single year. Then, of course, there's the junk bond market, which represents debt from companies with lower credit ratings, and that market is having its best year ever as investors reach for extra yield. The amount of junk bonds issued year to date in 2021 has already reached a record, and we still have over 2 months left in the year. I could go on, but I'll leave you with Elon Musk's company, Tesla, which recently reached market capitalization of over $1 trillion, and no company has ever reached a $1 trillion valuation based on such a small amount of actionable revenue. So Steve, I guess after all of that, I'm asking you a rhetorical question, but are we experiencing a market bubble, or should I say market bubbles, plural?
Well, market bubbles have existed throughout history, Fritz, and through lots of reading research, we've analyzed all the major market bubbles since the 1700s. And in fact, in our 3Edge model, we rigorously analyze all the market bubbles since the late 1800s. Now, some examples of more recent bubbles, one would be gold in the 1970s, where you saw an exponential rise followed by a precipitous fall. Japanese stock market, 1980s, again, another exponential rise, peaked in January of 1990, and then a precipitous fall. And then tech stocks, the famous tech stock bubble that peaked in March of 2000 and then fell more than 80% before stabilizing again. So there are these examples. Now, when I analyze whether one is in a market bubble or not, I look at 3 conditions that follow the pattern of past market bubbles. One, is there or has there been excessive monetary stimulus? And what we know today is that in the last 18 months, Federal Reserve Board created out of thin air more monetary reserves in those 15 months than they did in the previous 115 years. Tremendous excessive monetary stimulus. Number two, is there a self-reinforcing speculation that's going on? And what I mean by that is when prices start to inflate, and often because of central bank printing too much money, people notice those prices going up, and a group of speculators will say, well, there's a trend here. Maybe let's buy and jump on the trend and sell at a higher price. That makes the price actually go higher because they're buying that asset. That draws a new group of investors to come in. That drives the price even higher, and you have the self-reinforcing positive feedback loop or virtuous cycle that causes price to go up and over. And then finally, the third important condition is extreme overvaluation. It's okay if a stock market is climbing rapidly, especially if it's from an undervalued position. It's just getting back to normal. But if it's climbing in an exponential way and it's in extreme overvaluation, then that's another clue that perhaps this is a market bubble. And based on what you just said earlier, and based on all of our modeling and analysis, we think that the S&P 500 index in particular is extremely overvalued and historically overvalued. So we tick all three boxes and we say, yes, right now we believe the S&P 500 index is in a market bubble.
Terrific, thank you. So this week, John authors in our opinion article for Bloomberg mentioned how the idea of timing a bubble is seductive, but he went on to say that it's also close to impossible to do in practice. But he did say that oftentimes, however, investors think they're going to be the ones to get out at the right time. So if we're in a bubble, and when might the bubble end, and what are the risks to investors?
So if there's one common thread that I learned studying past market bubbles is that it's very true. Market bubbles often last far, far longer than logic would ever dictate. So you can't just apply logic and determine that you know just when the bubble is going to burst. And to go back to Sir Isaac Newton, the famous physicist, one of the key early laws of physics, a body in motion will remain in motion unless it is acted on by an external force. And so that's one reason why bubbles persist, because they get in motion, they get this self-reinforcing feedback loop, and they just continue. Now, ironically, Sir Isaac Newton was also famously a stock market investor back in the 1700s. And in 1720, after making a very healthy profit in the stock market, he logically decided that it was time to take profits, which he did, and made a tidy sum. His friends stayed invested in the South Sea, what became as the South Sea bubble, and the market went sharply higher, and he just couldn't take the pain of missing out anymore. And here, a genius, one of the most famous physicists, threw in the towel, put all his money back in the market, and happened to be right at the peak, and the market then crashed from there, and he lost his fortune. True story. So the bursting of a bubble is proven to be very hard to predict. But here's how we try to approach it. One, it could just be a black swan that comes out of the blue, like the threat of war or the threat of a new pandemic. It could be a sudden change in market psychology, which is very hard to predict when that might happen. A bit easier to predict could be looking for the early signs of financial tightening. And in 3Edge, our models are constantly assimilating lots of information every day. When we look at yield curves, are they flattening? That's an early sign of a financial tightening. Are credit spreads widening? Are there movements in the foreign exchange markets that show a dollar tightening, which is akin to a financial tightening? Let's look at real interest rates, so the difference between long-term yields and inflation, and that can show a sign of loosening or tightening. And then finally, there's what I call the Wile E. Coyote moment. And for those of you that remember Wile E. Coyote, a very clever character in cartoons, chasing the Roadrunner. And the image I remember is Wile E. Coyote in the chase, not realizing that he goes over the cliff and then all of a sudden sees and looks below and there's nothing there and then falls to the ground. And that's what I would call in a stock market bubble, nobody, all the speculators, they're just looking at how it keeps going up. They're not looking at valuation. They're ignoring valuation. And of course, in a stock market bubble, you get more and more excessively overvalued. Then all of a sudden, there could be this recognition. What are we doing here? These are crazy valuations. And then you get that sudden change in psychology and the big correction.
Excellent. So now I guess the most important question, which how might investors consider positioning their portfolios? Do they need to forego all potential future upside in order to protect themselves from, the eventual bursting of the equity market bubble?
Well, market bubbles, while they've existed throughout history, they're not that common. So we're living in a very special historic time right now. And during a market bubble, it's easy to be too defensive. You can recognize the market's overvalued. You could go all into cash, and you might miss many months of gains, and that's really painful. On the other hand, with market bubbles, it's very seductive, as you mentioned, and you could be too aggressive in just having a great time making money on the way up. But then the problem with market bubbles is often when they correct very suddenly, and many, many days or even years of gains can disappear in a moment. So we think an approach, rather than being too unnecessarily defensive or too aggressive and vulnerable to a sudden drawdown, is to have an approach that's both strategic and tactical. And by that I mean we are investing in equities, but we favor the relatively undervalued equities that are poised to have decent market returns over time. In an overvalued market like the S&P 500, while it could continue to go higher for the next few days, weeks, even months, with the excessive overvaluation, it's unlikely to earn, on average, a decent return over the next 10 years. We can invest in real assets, which will benefit if the central banks drag their feet too much and they're too behind the curve trying to fight inflation and withdrawing some of the successive monetary stimulus. The real assets like commodities and gold will do very well. We even have, although it's a small allocation, it's at the minimum of our range, an allocation to very safe U.S. Treasury bonds, which will do well under the one circumstance that the Fed overdoes it and they tighten too quickly and drive everything back into a disinflationary recession. And then finally, we do have some cash on the balance sheet, which could be thought of as dry powder to take advantage of lower, more favorable prices after the bubble bursts and after that correction. And then finally, with our model, analyzing and synthesizing lots of information every day and looking at all the important relationships, that's one way we can stay flexible and see the early warning signs when the bubble might be even more ready to burst.
Excellent. Great. Thanks. So, I think this is a topic that's important because I think oftentimes what happens is, it's tempting for investors, for all of us. You start to think that, well, this is normal, and you really only realize that we were all experiencing a market bubble only after the bubble bursts and the damage is done. So I think this is a timely discussion and very helpful. And so that will do it for Steve and me. We'll be back next week with another edition of the 3Edge Week in Review. And remember, all our videos are available on our 3Edge YouTube channel, as well as on our website at 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3Edge, thanks for listening.